Let's find out the cues that we've got from the global markets and how we can interpret it back here in India. William Lee, Chief Economist, Executive Director at Milken Institute, is now joining us on the show. Thank you very much for joining in. Let's start with the US CPI inflation print, right? A little hotter than expected, but not too hot. On the whole, in line. We kept thinking that this, the tariffs, will start hurting, will be inflationary. But is there any evidence of the tariffs imposed by the US impacting inflation? And then the weekly jobless claims at the lowest level in 4 years. What did you make of that?
Well, as far as inflation is concerned, people are looking with an extreme microscope to try to find some evidence that these tariffs are starting to take hold. They're starting to push up prices and push up prices on a widespread level enough to create inflation concerns. None of that has happened. We see some evidence that some prices are going up because of tariffs, but they are really small relative to the prices that are going up, not for inflation, not for tariff reasons. Households spend a lot of money on food. They spend a lot of money on shelter. They spend a lot of money on gasoline. Those are the things that are going up in a significant way that concerns the Fed, because the service inflation for housing really hasn't come down, despite the fact that real estate prices have come down. Energy prices, which were on a downward trend, have suddenly turned around. In fact, I think it's almost a 2% rise month over month. And that is a shocking reversal, considering that President Trump has made a high priority on lowering energy prices. And finally, food. Cattle prices and protein prices in general have popped up. And there again, it affects households' budgets tremendously, because again, we're talking about 12% of their budget on food, 6% of their budget on energy. And these are the items, I think, that where inflation is showing up, and that is not related to tariffs.
Okay, we'll see how those numbers shape up. As of now, just under 3% on a year-on-year basis, William. But overall, the U.S. market has been doing exceedingly well. Tech has been, rip-roaring higher. So if the market is doing so well, and if the economy is not really weakening, I don't know, give us your sense on the labor market because of those jobless claims numbers. Would you really... and tie that in with the Fed expectations. Is the market and the economy is doing well? Why should the Fed cut rates?
The market is doing well because the inflation fears have not shown up, but the labor market fears and the slowing that comes with the labor market, those are starting to gain some momentum. Today's unemployment claims is important because it shows that the momentum is not slacking off. And by the way, the Fed's new framework says they will not just concentrate on the unemployment rate the way they did before as an indicator of labor market strength or weakness. They're going to look at all of the indicators in a more comprehensive way. And that's why these claims have gained so much more prominence now, even though in the past they were considered as just noisy short-term data. Now they are an important part of the mosaic that gives us a picture of what's going on in the labor market.
All right. Hi, William. Good to see you. And as always, what are the odds, though? The markets are running up. The U.S. markets are running up in anticipation of this rate cut. The problem is the dollar index is weakened. So that's going to make imports a little bit more expensive for them. Mm-hmm. And the other point is this tariffs now, the negative impact will start being seen in the next few months. So it's going to be a little bit tricky because the Fed will cut rates in all probability. Do you see that the U.S. equity markets, after the kind of run that we've had, the challenges ahead as well, and the valuations, it's getting to the stage where the U.S. markets peak out?
Yeah, I remember a lot of this market strength was in a specific trade, the AI trade, the tech trade. And it's starting to broaden out because there's more and more confidence that the investment incentives put in place by President Trump under the Big Beautiful Bill and the tax reductions and they yet to see the regulatory dismantling, those are the things that are supposed to spur investment. And so that's why the market started to broaden, but not so much yet, right? The main part of the bets that are in the market are still on tech and AI. And the fact that the tariffs are starting to come into shape to bolster more foreign capital flowing into these sectors, that's, I think, a very good sign that specific parts of the market are doing well. Now, you're right. The dollar has come down a bit. But it's still higher than it was 2 or 3 years ago. It's come off of a huge peak of February, and I think that's where the overvaluation was, rather than the normalization that's taking place now is normalizing rather than a source of concern for a weakening dollar.
William, what's the view on India's macros? The Q1 GDP print was blockbuster, 7.8%. Then you've got GST rate cuts, which will further fuel demand in the second half of the year. But on the other hand, the rupee continues to hit record lows. I mean, tie that in. And what's the call on India now?
I think the call on India is still an optimistic one because of exactly what you said earlier, which is that the relations between U.S. and India have not been completely fractured to the point where they cannot be repaired. I think the ups and downs that we've seen since early February to the lows of the recent period when Prime Minister Modi started to make overtures to China and Russia and more strident statements about the BRICS countries. I think the core of the U.S.-India relations has to be a longer-term view. India needs the U.S. because of the complementary type of investments that we can take place here. India also wants to be a player on the world stage and doesn't want to be a handmaiden to the U.S. And it wants to make sure that the world knows that they are not going to be kowtowing to the U.S. And so that balancing act, I think, is going on. And I think everyone realizes it is a balancing act, and there will be ebbs and flows, but on average, the trend is very positive.
Okay, all right. And the market's been taking note of that here as well. William, great conversation as always. Thanks very much. You have a good evening out there, and we'll, of course, catch up again soon. Thank you.